The Federal Reserve has a dual mandate to promote maximum employment and stable prices. The key way it does that is through how it sets interest rates. High interest rates in a time of elevated inflation to help cool the economy down a bit, or in the case of high unemployment, setting interest rates lower, which can spur investment and increase hiring. Amid President Trump's tariffs on both allies and strategic partners, the Fed faces a unique challenge in addressing both parts of its mandate. Let's start with the stable prices. Because inflation has cooled in the last year, the Reserve Board has made small rate cuts, or in other cases, opted to at least keep rates where they're at. But if it becomes the case that inflation is elevated once again as a result of tariff price increases, we could see a reversal in Fed policy, which would mean the return of higher interest rates. As we know, tariffs not only raise prices, but also pose a threat to employment. Companies may opt to preserve their bottom line by cutting workers, which on a large scale could result in Fed intervention, normally the decision to lower interest rates. In summary, high prices the Fed responds to with high interest rates. High unemployment it addresses with low interest rates. You can't act upon either of these economic problems simultaneously, because as I've laid out, each requires a different response. And that's exactly why today the Federal Reserve once again decided to leave interest rates unchanged, because as it awaits more information, it'll be able to make a more well-informed decision about how to respond to the president's tariffs. Reporting in Toledo, Ohio, I'm Jaden Jefferson.